All right. Hello, and welcome to the inaugural episode of the Model Wealth Podcast. Well, not really. We don't actually have a podcast, but today we wanted to do something a little different for the Model Wealth Quarterly Insight. So instead of a presentation, we're recording a conversation, one that we hope that you will enjoy from the comfort of your desk, sofa, or the driver's seat on your daily commute. In 2024, the S&P 500 returned 25%. That's including reinvested dividends. Now, this comes after a 26.3% return in 2023. And these returns came amidst great uncertainty, including conflicts in the Middle East and Ukraine, as well as a contentious presidential election cycle and more. With 2024 now behind us, we thought the timing was ripe for a discussion about the present, as well as investment philosophy and how we go about planning for the future. So my colleagues joining us today likely need no introduction, but why don't we take just a quick minute to tell our listeners who is involved in today's conversation. Anna, would you mind beginning with a brief introduction?
Sure, yeah. I am Anna Thornburg, Director of Operations here at Model Wealth. I work mostly behind the scenes with Randy and Alex, just keeping the wheels running and all of that. But I probably have met a lot of you on a lot of different client calls. But it's nice to be chatting today.
Awesome. Welcome, Anna. Alex, how about
Yes.
you next?
I'm Alex Offerman. I'm the Director of Financial Planning here at Model Wealth. I'm also a financial planner with the firm. I'm super excited to have the conversation today and be here. I'm sure I've met a vast majority of you guys, maybe not all of Donovan's clients, but a vast majority of the clients that are currently listening or watching this. I'm sure I have met, and we look forward to expanding upon the conversation today.
I think it should be a conversation. Of course, last but not least, Randy, take it away.
I'm Randy Bruns. I'm the principal of Model Wealth, and I founded the firm in 2012. And that was after 10 years, one day shy of 10 years with JP Morgan Chase, working in the big banks. I finally said there are a lot of conflicts of interest on Wall Street, and I'd rather just shed those and work in a team environment.
Wonderful. Well, we love it. So this is, I hope, going to be a really engaging conversation. I'm confident with our the people that we have here today that it will be so. So again, just to kind of set the stage here, we've had two tremendous years of market performance. So let me throw this out there to you guys and get your thoughts. What is the market going to do in 2025?
I'll
I'm
start.
going to turn that. I'm going to turn that to Randy. Yeah,
Yeah, I'll
Randy
start.
knows where markets are going, so I'm going to turn it over to him.
I'll start. 10 years ago, I was, for whatever reason, interviewed by the Wall Street Journal. It was 2015, and I made a comment that I just got obliterated by the online comments. And I said, we want our clients to invest every single day as if tomorrow is the start of the Great Depression Part Two. And and maybe that didn't come across correctly, but my point was you should invest in a way that even if the worst possible crash in markets hit, that you could survive it. And somebody in the comments said, "Oh my goodness, does this guy seriously tell his clients that it's the Great Depression Part Two every single time they invest?" No, but one thing that I say a lot in meetings is you either don't have a clue where markets are going, or you don't have a clue that you don't have a clue where markets are going. And I can say for me personally, I am 100% confident that I have zero clue where markets are going. If I had to guess, I would say it's either going to be another fabulous year or a major crash, because that's just kind of how things work out. I'm gonna play a sissy here and just say I don't have a clue. I don't have a clue.
Well, I think that kind of level of humility is actually really important. Alex and Anna, just kind of leading off of some of the things that Randy has mentioned here, what are your thoughts on taking that approach? Why might it actually be helpful to invest as if, and again, respect to the Wall Street Journal listeners who didn't really like that comment, but why might it actually be helpful to kind of have that frame of reference where you're thinking, I'm investing and I realize that, hey, something bad could happen in the near future. Why could that actually be helpful as from an investing perspective?
Yeah, and I'll chime in, and if you have any additional
Go
comments
for it.
afterwards, it'd be great. I will say because it's going to happen. You are going to lose money into the stock market. It is going to happen from time to time. It is the price that we all pay for the long-term returns and the long-term rewards that we get from the markets. Markets cannot go up every single year. Yes, it seems like it has because it has over the last couple of years. It has gone straight up, but that is not something that is common or that should be thought upon of the same exact thing moving forward every single year that markets are going to continue to go up. There was a period of time from 2000 to 2009 that if you were a US stock investor that you actually lost money during that entire decade. Not to mention that inflation averaged about 2.5% during that same decade. So it was even worse from a real or an inflation adjusted standpoint. Everyone forgets that because it seems like it was so long ago. It wasn't that long ago. It was only 15 years ago that we lost for an entire decade, the US stock market lost value. And that's something to put into perspective that this is not something that's going to occur every single year moving forward of the returns that we have had over the last really 5 years, or even going back for the last 15 years, I guess, inside of markets.
Well, I think that's really valuable. Anna, we'll give you a second here to jump in as well with any additional thoughts that you have. But I think that's really valuable to remember because we tend to be pretty short-sighted as investors. We're coming off these two pretty good years, but we don't appreciate that it wasn't that long ago, this period that you're talking about where returns weren't so good. So in any case, Anna, anything else you'd like to add there from what
Yeah,
Alex?
I mean, I don't know. This doesn't necessarily apply only specifically to investing, but I think it certainly does apply to investing, where I personally like to devote as much of my time, energy, and thought to things that I actually can control and things that I can know. And I think what Randy and Alex have explained really well is that ultimately we can't control where markets are going and we can't necessarily know where markets are going, but we can make informed choices based on the things that we do know, to inform that choice. So yeah, I don't have a whole lot more to add there, but ultimately that, yeah, these are unfortunately unknowable and uncontrollable, but that is not necessarily a problem because we can still make choices based on the things that we do know. And I'm sure you guys will speak more to that.
I mean, I think that is such a strong point, though, to just appreciate what we can control and the things that we can't. Now, that actually leads really well into my next question. And the question is this. So every single day, there are really smart people with really fancy titles, maybe really expensive degrees, getting paid really big dollars. They go out and speak on TV or on podcasts, or write in the newspaper, and they're confidently predicting the direction that the markets are going to go, or at least they're providing this appearance of certainty about what's going to happen. And some people might wonder, like, hey, shouldn't I listen to them? This person has a really fancy title. This person has a big institution behind them. Do they have special knowledge that can help me beat the market? What do you guys think about that if someone comes to you and says, hey, this person's really smart, this is what they say is going to happen? What's your take?
Randy, I'll let you start. I'll let you kick it off.
Well, I'm just going to say, so this is the one field, topic, industry, whatever, that the more you know about the markets does not give you, well, it's specific to investing. The more you know, there's going to be somebody else just as educated, just as intelligent, just as informed, just as much money to manage, and you're up against that person. And if you ultimately, you're just canceling out each other's bias. So if some person who's really well trained, has an MBA from Harvard, whatever, believes now is a really good time to dump Coca-Cola stock, somebody else just as informed might believe it's a good time to buy Coca-Cola stock. But even if that person, I think what happens is people kind of believe that it's these people up against, just some little old man who has a whole bunch of Coca-Cola stock to sell, for example. So I'm going to flip the table here. And if let's say he's going to market and is willing to sell it just for a really big discount to its fair market value, everybody in the industry is looking at him saying, well, that's not what it's worth. And they're all just going to bid it up to the fair market value. And so there is really no way to beat the market, because the market is the collective knowledge of everybody, all those experts. And the problem is all those experts charge fees. And if you look at the data, there are just mountains upon mountains of academic evidence that shows that an unmanaged index or measuring stick of the market has just trounced actively managed or human run mutual funds. And there was an individual, I can't think of his name, Legg Mason. Alex, is it the Legg Mason Value Fund? Anyway, some individual had just beaten the S&P 500 for like 15 straight years or 10 straight years, and all of a sudden all the funds went into that. Or more recently,
Kathy Wood.
Kathy Wood of ARC Innovation Fund or whatever. All of the assets chased that at the worst possible time, and she has lagged the market for a very long time. Bottom line is you cannot beat the market.
So that's really interesting, Randy. Let me toss it over to Alex for a quick follow-up question. Now, let's assume now that you guys have convinced me, right? You've sold me on the idea I can't predict the market, right? Now, I didn't need any convincing, but you guys have done it. Okay, you guys have done it today. So I recognize I can't predict the market really with any certainty. I can't do it consistently year over year, right? I can't really separate whether I'm making picks and just getting lucky or if I have skill. I can't really pull that out. So how am I actually supposed to invest? Now, Randy kind of sprinkled in his answers some of those things, but Alex, if you're meeting with a new client, they're coming to you and they're like, hey, how do I go about doing this investing thing? What would you say are like the most important investment principles that they should live by, in your opinion?
Yeah, there's a couple of them. And of course, there's no one size fit all, but there's three major components I think that make for a successful investor. It's one, owning an allocation that you are comfortable with and sticking with it even in the worst times. So I emphasize that because there's so many individuals, or there's individuals that will, when markets fall by 30%, and you turn on the news and you say, and it's everywhere. Everywhere you look is this doom and gloom, and I gotta get out. They are telling me I need to get out. And one of Randy's favorite sayings, whenever we have clients that say they are telling me I need to get out, we're like, who is they? Who's they telling you to get out of the markets? It is better to own a more conservative allocation from the start if you are going to stick with it than being more aggressive and trying to become more conservative in the downside of markets. It's going to happen. So again, be comfortable with your allocation that you have today, and stick with it even through the worst times. Make sure that your costs and your fees are lower. This is one of the only industries that the lower cost that you pay, the more return that you actually get to keep. That is unlike any other maybe industry, maybe a painter. You don't want to go out and hire the cheapest painter because it probably coincides with very not great work. Inside of financial planner investing, the lower that you pay in fees, the more that you get to keep in the grand scheme of things. So that's why indexing or being a passive investor ultimately outperforms being an active investor, as Randy was alluding to a moment ago. And then last but not least is being diversified inside of those investments, not owning just one stock, not owning just hypothetically Nvidia because they have done the best over the last few years. It's better to be diversified across all major asset allocations, not only just in the US, but also internationally as well. Being a global investor is important inside of being a successful investor over the course of time. So those were the three principles that I would say: stick to your allocation, and even in the worst times, still stick with it. Make sure that your costs and your fees are low, and also make sure that you are globally invested or well diversified across all major asset classes.
Yeah, well, very well said. Anna, let me toss a question your way, right? So again, coming into the entry of 2025, two really good years in the market. Yes, scary things happening in the world, but the markets have persisted. They've been really, really strong. What do we do if 2025 ends up being a really bad year? And of course, on the other side, what do we do if it ends up being a really good year?
Yeah. Yeah, I mean, I would say, first of all, for myself, there's nothing wrong with being happy that 2023 and 2024 were good. So
Absolutely.
I think there's, you can celebrate the wins, and I think that is regardless of how 2025 goes. 2023 and 2024 were strong years in terms of market gains and all of that. So I think that's a positive side of things. And I think Randy and Alex have already said this, but in terms of 2024, 2025 going well or going poorly, you stay the course. So that makes things easy. I would say, don't check your portfolio balances constantly. We always recommend that to our clients. That people who there are some statistics that go to show that the more often you check those sorts of things, the more likely you are to make mistakes in those areas and see the consequences of those mistakes. So not to put on blinders altogether, but also if you're our clients, we're keeping an eye on these things for you. So you have that as a benefit. But so I would say it's okay to be glad about things that have gone well and then to just kind of stay the course for 2025 and see what happens. So I wish that there was something a little more specific and actionable, but I think that's how I would approach it personally, and that's what I would recommend. So
And
And then
Alex says in meetings, if we knew that answer, we wouldn't share it with you. Alex specifically says, I'd be off on an island and I wouldn't be sharing that advice.
I specifically tell, and it's a joking fashion, of course, but I say I would not be talking to you schmucks. I'd be off on an island somewhere managing my own money because I would know where markets are and I'd be very wealthy. But no one knows that answer to what everyone has said.
Yeah, staying the course is just so key. And as you mentioned, our human instincts do tend to play against succeeding as investors. We want to take action if the market is doing scary things, if the world feels like it's on fire, we feel like we've got to do something. But the refrain is actually don't just do something, sit there, right? Don't take action. Pause. And to reference that, that research that you were talking about, trading, there's a really fascinating article that's titled Trading is Hazardous to Your Wealth, right? And so that is what the data has showed. Indeed, on average, you tend to do poorer the more often you trade. Okay, so just kind of closing things out here, two final thoughts. So the data does tend to suggest that you are better off on average with a long-term buy and hold, keep costs really low strategy than the alternatives, right? There's a lot of different ways to invest, but those strategies that we've just described tend to be better on average over a long period of time than the others. So my question for you guys is, why are we as humans so obsessed with chasing returns, right? I mean, the data is pretty clear, but nonetheless, we're going to have these conversations every year as humans, not just here at Model Wealth, but every year, people on TV, on podcasts, in the newspaper, they're going to be talking about strategies to beat the market. Why are we so obsessed with it? What do you guys think?
I'll say that the financial media, nobody's going to tune in to the buy and hold channel. It's not going to sell any revenue. So it starts with the media because you've got CNBC, whatever, all these channels. It's like I go to the gym and it's just the stock tickers, and then you'll just see a lot of old men for whatever, or just men in general. Men are worse at this than women, and Fidelity has the data to show that men think they can overthink this, but we know some women that make some really bad mistakes as well. And I lost my train of thought now. Alex, in here.
Yeah, I'll chime in and just say the reason everyone chases returns because there's always a story. I was just talking to a buddy the other day that says, and again, no political comments here, that he bought Trump coin on Sunday when it started to go crazy and he made 300% on it and got out. And he was like, that was awesome. That's easy. I made more than I've made in the stock market over the last 7 years of me investing since I've gotten out of school. And we're sitting at a table talking to there's 3 other individuals like, well, that seems easy. Why am I even making contributions to my 401k? He made more in a matter of a 24-hour period than I did in the total of 7 years of me being an investor. That is the reason why it's so hard and why individuals chase returns. Yes, it's one story, but you know what else we also don't hear? Is the individual that also bought that same exact coin at the highs and lost 40% of its value 3 minutes later. No one's going to come out and voluntarily give that information. Hey, I just lost 40% of my wealth because I invested in a meme coin that I thought was going to go higher. So it's bias in the opinion that everyone is talking about how much they're winning or what the winners are inside of their portfolio, but they're never talking about the losers. And it's the one of my favorite quotes, and it was from Morgan Housel's Psychology of Money. He talks about Warren Buffett. Warren Buffett is praised to be one of the greatest investors of our generations. Well, if he retired at the age of 65, no one would know about him. Why? Because 99% of his wealth was accumulated after the age of 65. And one of my favorite quotes in that book from Morgan was saying his skill is investing. His skill is not investing, it was time. And that's exactly what it is. It's time in the markets. There's no overnight success inside of stock markets. And if there is, you may be taking on too much risk that's actually a detriment to you. So I think that's why it's hard for individuals to stay the course, because they see other individuals or see it on the news, as Randy was alluding to. No one's going to watch the buy and hold TV or buy and hold TV. And you turn on CNBC and you see, wow, this meme coin, whatever it may be, or this stock, Nvidia, is up 1,000% over the last 6 years. Well, why wasn't I invested in Nvidia? Well, because hindsight's 2020. No one knew 6 years ago that Nvidia was going to do exactly what it did, or just any other coin. So I always like to say that it's luck, and it's better to be just invested in the market and let markets do what markets do over time and compound, and let it continue. Again, let markets do what markets do.
It does just seem to me that social comparison can really just be our downfall. And we do hear stories about someone who made it big, but we really do need to be clear about the difference between investing and speculating.
Yeah.
When we're making a short-term strategy move where we're putting a bunch of money into something, we're trying to get a quick turnaround, that's a lot more like speculation than it is like investing. We're putting money in something we think is going to be profitable for a very, very long time. So this has been I think a conversation abundant with really, really interesting things to think about. I'd like to wrap us up here. Again, the timing is ripe for a conversation like this, when maybe it feels like everything is going so smoothly, at least in the investment markets. It doesn't feel smoothly in most of the world, but when it comes to investing, things have felt pretty good the last few years. And so, it's helpful to have a conversation every now and then and just recalibrate in terms of our expectations and going back to those kind of bedrock foundational investing principles. So hopefully we've been successful in that way. So I'd like to close this out, with each of us providing just one key takeaway, one important thing that you want listeners to remember as they go into 2025. And so, Alex, could we start with you? Maybe we'll go Alex and Anna, and then Randy will have you close it out.
I will say, as following up from everything that we said here a moment ago, we don't know where markets are going to go in 2025. No one does. And if they do, you should probably run far, or if they say that they do, you should probably run far, far away from that individual, in my opinion. But I will say you should embrace market volatility. It is a good thing to have. It is not something that you should shy away from. You should learn to accept it, because it is a part of being a long-term investor, and make sure that you understand, not only in the terms of a percentage, but dollar-wise, what your portfolio can lose. It is something to be, again, it should be embraced, but you should quantify that in dollars. So instead of saying, hey, if I have $1 million portfolio and the stock market lost 30% this year, well, that's not 30% and whatever. It's $300,000 to the $1 million investor. You should quantify that in dollars when you think about your portfolio and volatility. But my main takeaway is you should embrace market volatility. It is there for a reason. It is the reason why we get rewarded with the long-term returns inside of the stock market. And it's not something to be, I don't want market volatility. We haven't had much market volatility over the last couple of years. And I think that is, it has been beneficial. As Anna said, we should be happy that that has occurred, but that is not normal. And the volatility is going to come at some point in time, and it's something that we should all embrace as long-term investors.
Alex, that was so good. I don't want to
Yeah,
follow
say,
that.
you didn't give us anything.
I,
No, I mean, I think I would just say ultimately that, you know, the fear impulse, not being certain about the future, and also the desire for greater wealth are very normal. And that ultimately it's important to be able to separate those emotions from the investment decisions that we make so that you aren't led into, Donovan, like what you were saying, speculation or avoidance. Because I think that is a trap that a lot of people can fall into. So I would say that if you have a really hard time with that, then maybe just protect your mental health a little bit by having some structures around when you check things and how you do that. And like Alex was saying, keeping in mind some of those numbers of what are reasonable fluctuations that you can expect to see. It's okay if you don't enjoy seeing those fluctuations if they go downward, but also to manage your expectations when you see the fluctuation in an upward direction as well. And to realize that those are not final, that they are in flux, and that ultimately that is all right in the long run because, like Alex said, the volatility works in your favor in the long term, and in the long term is really important to remember.
And I'm a statistics nerd, so I'm just waiting for Vanguard to come out with its market risk and reward chart for that includes 2024. That will be 99 years of market data for stocks, bonds, cash, and inflation. That means this year is the 100th year. But in those 99 years for US stocks, just 6 times. So the stock market has averaged 10% over the 99 years, roughly. Just 6 of those years fell within 2 points of that 10% average. So volatility is very natural. You should expect it. And if you need your money sooner, don't invest it in the stock market. If you get a 30% return, that's just part of the ride. If you lose 30%, that's just part of the ride. Do not invest in the stock market unless you have a very long time. Now, granted, a whole bunch of people are listening to this saying, well, wait, I'm retired. Well, yeah, that's if you're retired, you're taking out maybe 4 or 5% at most from your portfolio. So you do have portions of your funds that are still 20, 30 years down the road. And the only other thing I would say is, and Alex and Anna mentioned this, don't focus on things that are out of your control. Focus on the things you can control. Do you have a will or a trust? If you become incapacitated, who's managing your finances? If you're in a hospital bed, who's making your health decisions? If you have somebody dependent on your family, do you have a term life insurance policy? I saw a post on Facebook the other day for an individual who was 44 years old who passed away, unfortunately, and they're trying to raise money for his family. And I'm making an assumption here that that individual unfortunately did not have enough life insurance. It sounds insincere, but that's the reality. Is if you have individuals reliant on your income, get a term life insurance policy. Know your tax situation. Understand what opportunities are there. I could ramble on and on about things you can control. People say, well, how much time do you guys spend on the actual investments? It's actually pretty simple. The heaviest work we do is digging through home and auto insurance policies, employee benefits, taxes, things like that. So that was just a plug for solid financial planning. The investment stuff, it is out of your control, other than carving out your cash for the short term and identifying what is long term and knowing in your mind how much it can fall.
Hey,
Randy?
Donovan, what would be your one takeaway
There
from
you
this?
go.
Yeah, I think that I'm gonna harken back to what Anna said earlier on in this conversation, which is just the value, the importance of staying the course. Alex, you mentioned the importance of asset allocation, and I really think that you need to have an investment strategy that you can enjoy when things are going right and endure when things are going wrong. So we don't know what the future has to hold. It's impossible to predict with certainty and consistency what's going to happen. So let's make sure that whatever strategy we have, we're going to be able to enjoy it and endure it both at the same time. So Randy, Anna, Alex, thank you so much for your conversation today.
Thanks for hosting, Donovan.
Yes, thank you, Donovan.